Welcome to the 2026 Strategic Review of SK Innovation. This presentation, prepared by HDIN Research, examines the company's structural transformation into a global green energy leader. Following a series of significant mergers and technological pivots, we provide an objective analysis of SK Innovation's ability to navigate the evolving energy landscape. We begin with the executive summary. SK Innovation is executing a quote, green anchor strategy, balancing the reliable cash flows of its traditional petroleum business with high-growth future energy assets. The integration of SKE&S has provided a necessary financial cushion to manage the current EV chasm while maintaining a massive asset base of nearly 108 trillion Korean won. Looking at the revenue structure, petroleum remains the primary contributor at 58%, serving as the group's foundational cash cow. However, the portfolio is rapidly diversifying. The new E&SEIC business now accounts for 14%, while the battery unit and lubricants segment represent critical growth and high-margin pillars, respectively. SK Innovation's primary competitive advantage lies in its vertical integration. By controlling the chain from upstream exploration in Southeast Asia to downstream power solutions and EV batteries, the company can optimize margins and secure feedstock during periods of supply chain volatility. This integration creates a closed-loop energy ecosystem. Financial stability is supported by an asset base of 107.9 trillion Korean won. Our analysis shows that total liabilities have been managed effectively post-merger, with a liability-to-equity ratio of 178%. Management remains focused on inventory optimization and improving liquidity ratios as high-scale investments move toward completion. The company's manufacturing scale is reaching a critical inflection point. With a targeted global battery capacity of 192 gigawatt-hours by the end of 2025, SK Innovation has established strategic hubs in the US, Europe, and China. This regional diversification allows the company to meet local content requirements and minimize logistics costs. Technology serves as the defensive moat. With nearly 13,000 patents, SK Innovation is not just a manufacturer, but a technology developer. Research focuses heavily on next-generation cell-to-pack technology and molecular analysis, ensuring that the company maintains its leadership in high-nickel battery performance. The transition is not without challenges. The global EV market is currently navigating a quote, chasm phase characterized by a temporary slowdown in adoption. This is compounded by high interest rates, shifting purchase subsidies in North America, and seasonal manufacturing breaks from major auto OEMs. Examining 3Q 2025 performance, we see a consolidated operating profit of 573 billion Korean won, a sharp recovery from the previous quarter. However, the battery unit still faced a quarterly operating loss of 124 billion Korean won due to volume fluctuations and initial fab costs, highlighting the continued need for operational efficiency. The petroleum segment faces structural margin pressure. Rising Dubai crude prices combined with a downward trend in gasoline crack spreads have squeezed margins. While heating oil and kerosene provide seasonal support, the volatility in refining spreads remains a risk factor for the group's internal funding capabilities. The financing requirement remains intensive. With nearly 45 trillion Korean won in total debt and significant current portions due, the company must balance its aggressive capex, specifically the 1.9 trillion Korean won dedicated to batteries and materials, against the need to preserve credit ratings and liquidity cushions. Geopolitical factors, particularly the US IRA and EU battery sustainability laws, require constant monitoring. SK Innovation operates its China-based facilities in strict accordance with UN-recognized One China principles and local regulations, while simultaneously building supply chain resilience to mitigate trade barriers in Western markets. The central question for the 2026 fiscal year is fundamental. How can SK Innovation effectively utilize its new merger synergies to stabilize the balance sheet and bridge the EV market slowdown while securing a long-term lead in future energy technology? The first part of the answer lies in the merger with SKE&S. This unit provides a stable buffer with consistent 10% plus operating margins. By integrating LNG upstream production with power generation, the group secures lower-cost energy for its manufacturing sites and a steady EBITDA flow of approximately 1.4 trillion Korean won annually. To improve financial health, management has secured covenant waivers and utilized strategic capital infusions, such as convertible bonds. Divestments of non-core businesses are sharpening the focus on high-yield assets, aiming for a debt-to-equity ratio below 175% by year-end. On the technology front, SK On is diversifying its chemistry. While high-nickel NCM remains the premium standard, the first mass production cycle for LFP batteries in 2025 addresses the mid to low-tier EV market. This broadening of the product shelf allows the company to capture a wider range of OEM demand. The utility-scale ESS market represents a major pivot. The 7.2 gigawatt-hour supply deal with Flatiron Energy demonstrates that battery revenue is no longer solely dependent on passenger EVs. U.S.-made ESS modules qualify for significant tax credits, creating a high-margin revenue stream that is less vulnerable to EV market cycles. The lubricants business is undergoing a pivot. SK Enmove is moving from traditional ICE lubricants to electric vehicle e-fluids and immersion cooling for AI data centers. This transformation ensures that one of the company's highest-margin businesses remains relevant in a post-combustion era. The E&P segment, operated by SK Earthon, is focusing on regional efficiency. By concentrating on high-probability resource clusters in Vietnam, Malaysia, and Indonesia, the segment maintains high profitability, reporting a 27.9% operating margin in 3Q25, while aligning with carbon capture goals. In our benchmarking against global Tier 1 peers, SK Innovation scores exceptionally high in technology mode and policy support utilization. While scale and cost control are currently being optimized through the merger, the company's ability to navigate financing remains stronger than smaller, non-integrated competitors. Looking ahead to 2026, we anticipate a recovery in refining margins and a steady quarterly turnaround for SK On. Strategic milestones include the commercialization of semi-solid battery prototypes and a 20% increase in synergized EBITDA power across the consolidated entity. This concludes our strategic analysis. SK Innovation is positioned for long-term value creation through its integrated energy model. For in-depth market research reports or customized consulting on the energy sector, please contact HDIN Research at sales@hdinresearch.com.